average house prices across the European Union have skyrocketed by an insane 55.4% since 2010, completely blowing past wage growth. And if you think a standard deposit is just a few grand, brace yourself. In the United Kingdom, the average first-time buyer is now slapping down a mind-boggling £61,900 just to get the keys. That is not a typo. That is a down payment the size of a luxury sports car. Hey friends, X-Money Lab here. But before you pack your bags and give up on home ownership entirely, the reality of getting on the European property ladder might not be as impossible as that huge number sounds. So, how much cash do you actually need in your bank account today? And where are the hidden trapdoors? 1. The 20% myth. For decades, financial experts drilled one golden rule into our heads. Save up 20% of a property's value, or do not even bother calling a bank. But here is the wild truth about buying a home in Europe today. That 20% rule is completely dead in some markets, while in others, it is actually a dangerous illusion that hides much higher costs. Let us start with the United Kingdom. On paper, you absolutely do not need a massive 20% anymore. The government actively pushes a mortgage guarantee scheme that encourages lenders to hand out 95% mortgages. That means you only need a 5% deposit to get started. According to Finder, the average house price for a first-time buyer was £226,000 in early 2026. 5% of that is just £11,300. Sounds completely doable, right? So why are people paying huge deposits in reality? Because a 5% down payment usually comes with brutal interest rates and incredibly strict affordability checks. Lenders are terrified of you defaulting. When property values are sky high, putting down a tiny deposit means borrowing a massive mountain of cash. If your current salary cannot comfortably cover the heavy monthly repayments on that gigantic loan, the bank will flat out reject your application. This harsh reality forces young buyers to save much larger chunks of cash just to bring the total loan size down to a number their monthly wages can actually support. Now, look across the rest of Europe and the rules change completely. Over in Sweden, the law currently forces you to put down a minimum of 15%, though lawmakers are actively reviewing a proposal to drop that barrier to 10% by 2026 to give first-time buyers a fighting chance. Then you have countries like Spain and Italy. In those markets, the standard mortgage deposit is still stuck at that old-school 20% mark. But here is the hidden trapdoor nobody warns you about. Additional purchasing costs, legal fees, and hefty government taxes can easily add another 10% to the upfront cash you need. That means you are not saving 20%, you are scrambling for 30% in cold, hard cash just to cross the threshold. The advertised minimum limit is rarely the whole story. 2. Hidden transaction costs. Imagine slapping your hard-earned deposit on the banker's desk, only to be told you are still tens of thousands of euros short. Why? Because across Europe, securing the actual mortgage is only half the battle. The other half is a brutal, un-mortgageable mountain of hidden transaction costs that lenders flat out refuse to finance. You cannot borrow this money. You cannot conveniently roll it into your 30-year loan. You have to cough it up in cold hard cash on day one, or the deal falls apart. Let us look closely at France, a prime example of this absolute financial trapdoor. Say you find a charming older apartment in Lyon for €300,000. The bank graciously agrees to a 10% deposit. You pop the champagne, thinking €30,000 gets you the keys. Wrong. Enter the frais de notaire, or notary fees. In France, purchasing an existing property slaps you with roughly 7 to 8% in mandatory notary and registration fees. That is an extra €24,000 that must come straight out of your checking account. And you cannot shop around for a cheaper option, because these are heavily regulated state officials. The bank will not lend you a single cent for this. Now, drift over to Southern Europe, where local governments treat property transfers like a massive ATM. When you buy a home in places like Spain or Italy, you are hit with property transfer taxes, stamp duties, and mandatory legal fees. If your lender demands a standard 20% deposit on a €300,000 villa, that is €60,000. Add those hefty government taxes and legal fees, and suddenly you need €90,000 in liquid cash. Your 20% deposit practically mutated into a 30% cash barrier overnight, completely destroying your budget. But wait, the wallet draining does not stop at taxes. Depending on the exact region and local laws, real estate agency fees are sometimes directly split between the buyer and the seller. If you are on the hook for a 3% buyer's premium, that is another €9,000 vanishing into thin air. Then you have bank valuation fees. Before the lender even approves your mortgage, they will send out an appraiser to ensure the house is actually worth the asking price. Guess who pays for that appraisal? You do. And here is where a massive hidden nightmare lurks: the appraisal gap. Let us say you agree to buy a place for €300,000 because the market is hot and bidding is fierce. The bank's appraiser comes out and says, "Sorry, this place is only worth €280,000. The bank will only calculate your mortgage based on that lower number. That €20,000 gap? It falls entirely on your shoulders. You have to cover that difference in pure cash, on top of your initial deposit, on top of your notary fees, and on top of your government taxes. Throw in mortgage arrangement fees, structural survey costs to make sure the roof is not going to cave in, and basic legal representation, and you are bleeding thousands of euros before you even own a single brick. This is the silent killer of first-time homeownership. People spend 5 years aggressively saving exactly 10% of a property's value, completely ignoring the transaction costs. When they finally apply for the mortgage, the underwriter looks at their bank statement and says, "Great deposit, but how are you paying the tax man?" This harsh rule completely changes the math of buying a house. A 10% deposit system is actually a 15 to 20% cash requirement in disguise. It creates a massive liquidity crisis for young buyers. You might have a fantastic salary that can easily afford the monthly mortgage payments, but unless you have an extra €30,000 lying around just to pay the government and the lawyers, you are locked out. This absolute wall of upfront fees is exactly why we are seeing a massive generational wealth transfer just to cover the baseline costs of buying a home. According to Savills research, over half, specifically 53%, of first-time buyers in the United Kingdom now rely on financial help from their families, famously known as the bank of mum and dad. While lenders might advertise low deposit schemes, the sheer weight of stamp duty, legal fees, and moving costs forces young people to beg their parents for a bailout. They are not just borrowing for the deposit anymore, they are borrowing just to pay the transaction taxes. 3. Government buyer schemes. If begging your parents for cash is not an option, you might think the homeownership dream is completely dead. But here is the massive plot twist. Governments across Europe are absolutely terrified of an angry generation of permanent renters, so they are stepping in to artificially smash that barrier to entry. They are playing the ultimate financial guarantor. Take the United Kingdom. For a first-time buyer, the average house price currently sits right around £226,000. Trying to save 20% of that while paying sky-high rent is a mathematical nightmare for most young workers. But under the government's official mortgage guarantee scheme, the state steps in and basically tells the bank, "Do not panic. If this buyer defaults, the Treasury will cover the losses." This massive federal safety net completely changes the lender's risk profile, encouraging them to confidently offer 95% mortgages. Suddenly, your upfront cash requirement plummets to just 5%. For that average starter home, you are now looking at a down payment of exactly £11,300. The hurdle shrinks from luxury sports car money down to decent used sedan money. Now, if you think a 5% deposit is a sweet deal, jump across the sea to Ireland, where the government is practically handing out real estate cheat codes. They operate a brilliant setup called the Help to Buy scheme. Instead of just lowering the bank's strict lending rules, the Irish state literally gives you your own income tax money back to use as a deposit. If you are purchasing a newly built home, you can claim a massive tax rebate of up to €30,000. That is real, liquid cash injected directly into your deposit fund. If you have spent the last 4 years dutifully paying taxes, the government hands a giant chunk of it right back to you at the closing table. But before you start throwing a parade for these politicians, you have to realize there is always a catch. These regional buyer schemes are highly engineered financial tools with very strict borders. Ireland's €30,000 rebate? You are legally restricted to buying brand new builds, which are conveniently priced at a hefty premium by developers who know exactly how much government cash is in your pocket. And that UK 5% guarantee? It only solves the deposit problem. you still have to convince the bank's underwriter that your monthly paycheck can comfortably handle the massive loan for the remaining 95% of the property. The state can magically shrink your upfront deposit, but they absolutely will not pay your monthly mortgage. 4. The exact number needed. So, let us stop beating around the bush and look at the hard math. What is the absolute minimum cash you need in your bank account today to get the keys? If you are leaning on a state-backed 5% guarantee, or buying in a much cheaper town far outside the major capitals, you are looking at the 15,000 to 20,000 euro bracket. This covers a bare minimum deposit on a modest starter home, plus just enough left over for the absolute basic legal fees and moving trucks. But if you are buying on the open market with a traditional lender in a decent city, get ready for financial pain. Between a standard 15 to 20% down payment requirement, like they currently demand in places like Sweden, though lawmakers are frantically trying to drop it to 10% by 2026, and those crushing transaction taxes, the bill skyrockets. You are looking at a massive 75,000 to 90,000 euros in pure liquid cash. So, is the European home ownership dream completely dead? No, but it has drastically mutated. If you are willing to hunt for newly built government-subsidized zones, live an hour outside the city center, and rigorously navigate state rebate schemes, yes, you can definitely squeeze through the door. But if your master plan is to simply save 10% of your salary while paying sky-high city rent, and buy a standard house without any family help, the math simply does not work anymore. Unless you have a secret wealthy uncle, the system is fundamentally broken for the average independent saver. You either play the government's highly regulated game, beg your parents for a massive bailout, or keep renting indefinitely. It is a brutal housing market out there. But knowing the exact upfront numbers is your best weapon against bank underwriters. If this reality check saved you from a nasty financial surprise at the closing table, hit that like button, subscribe to X Money Lab, and stay sharp out there.